If you want, we can wait for a couple more people, or we can go ahead and get started. Your call, Laura.
I say go ahead.
All right. Okay, cool. Then in that case, okay. Well, hello everybody. Thank you so much for logging on this call in your afternoon on a Thursday. Hopefully you guys are staying safe from all the fires and everything else going on in the world right now. So my name is Jerry Wu. I'm with First American Title. I want to first of all thank you, Laura, at Tri-County Association of Realtors, for having me on to teach this class for you guys. We're going to spend about an hour together today, going over everything from the basics of title. So if you're a new agent, or if you just got into the business for a year or two, I will spend a little bit of time just talking about the basic information of title insurance. We'll go over then what are the different vesting methods. That's often the question that people have, like, how should my buyer hold title? Joint tenants, tenants in common, trust, what does that all mean, right? And how should I advise them, if I should advise them? We'll go over some red flags on prelims, some things that I'm seeing in the industry, some things that would slow down the transaction for you guys when you guys are in escrow. So we'll try to cover all that in within an hour. And I know, Laura, you usually record the video, right?
Yep, this is being recorded, and then it will be on the Tri-County's website later for you to review.
Okay, so yeah, anybody that would like the video, make sure you go back to tricorealtor.com, and I believe back on the calendar page, right? It'll be there. So, all right. So if you guys don't mind, I'm gonna go ahead and get started. I will start sharing my screen. Give me one sec. Hopefully you guys can all see that. So let's talk a little bit about title. Again, I'm with First American Title. We're we're the largest single title insurance company in the industry. Been around for 130 plus years. But with that said, title hasn't really changed that much through the years. The way that we transfer title, the way we do things, really has been the same for the last, 50, 60, 70 years probably, transferring title, deeds, and so forth. So we'll talk a little bit about what all that means. Now, let's take a look at what is title insurance, all right? Now, here it says title insurance protects you against covered title defects, like a previous owner's debt, liens, and other claims of ownership that may have been instituted prior to the purchase of your home. Now, what does that mean? Right? I know it's a little bit confusing. Honestly, I don't even really fully understand the full meaning of that. To simplify it, all that really means is that saying that the property you purchase is yours. All right, the property you purchase is yours, and that no person, no lender, no entity from the past can come back and threaten the ownership of your property. All right, that's really what it means. So you might ask, well, why do I need insurance on ownership, right? And it's a good question, because really nothing else that we do in the world requires insurance for ownership, right? We buy a car, we have insurance, but the insurance is in case I get into an accident, right? It's not to ensure I own the car. So this is a very, very unique concept that really only applies to our particular scenario. So say, for example, you go to Best Buy, and you go to Best Buy or you go to Target and you buy a TV, right? You give them, let's say the TV is $500. You give them $500, they give you the TV. It's a done deal. There's no insurance I need to buy to say I own the TV. Well, see, real estate is a little bit more complicated, right? Because what if, theoretically speaking, what if the person that sold you the TV didn't really have the right to sell you the TV, right? What if that TV was owned actually by 3 people, passed down from generations to generations? Then who's really the owner, right? You don't want to buy that TV and then 6 months later somebody comes knocking on your door and says, hey, actually I was 1/8 owner of that TV. I didn't agree to sell it to you. See, in that scenario, your ownership is now threatened. Or for example, let's say whoever owned that TV had to take out many loans to buy that TV, or maybe that TV was used as collateral for other loans. You see, now that's going to be affected if those loans aren't paid back, and now you're the owner of the TV. See, all these can affect the ownership of that TV that which you own, right? So that's really what title insurance is. It insures against ownership. Awesome. Let me, you know what? Where's my chat box? Hold on, guys. All right, so I'm gonna have the chat box open. If you guys have any questions, you're welcome to unmute yourself, or if you just wanna type in the chat box, I'll try to get to it as fast as I can, all right? So this says, how is the title insurance different from traditional insurance policies? I talked a little bit about this already. You know, title insurance guarantees ownership, all right? Now, title insurance is good for as long as you own the home. All right, let me repeat that. It's good for as long as you own the home. If you own it for 100 years, if you live to 100 years, then that policy is good for 100 years, all right? And there's only a one-time premium that's paid at the close of escrow. So unlike other insurance premiums, there's no like monthly premium, there's no like annual premium. It's good for just one payment as long as you, and good for as long as you own the home. Now, there are usually a couple of different types of title insurance policies. All right, let's talk a little bit about these different types. So there's a loan policy and an owner's policy. The owner's policy is kind of what I've been really talking about. It's, you know, it's the one that ensures your ownership. It's good for as long as you own the home, etc. Now, here in Southern California, many of you already know, even though this owner's policy ensures the buyer, it's common business practice here in Southern California that the seller pays for the buyer's owner's policy, all right? It's all negotiable. You know, there's nothing saying that the seller always has to pay. You know, oftentimes when you buy a new home, the builder makes you pay everything anyway. So, but commonly that's the case. If you go to Northern California, if you go to other parts of the country, it could be completely different. It's just the way we do things here. Now, it's good for as long as you own the home. Here's the caveat. Unless you change title. Here's the thing a lot of people miss. They think, I have title insurance. I want to change title to my brother, change it to my sister, change it to my friend, change it to my girlfriend, whatever. Once you change title, then that insurance policy is no longer good, all right? Same thing if you're to change it to an entity, like an LLC. I'll tell you a story of what happened to a guy. So this isn't one of my cases, but this is, you know, a friend of mine was telling me this happened to him. So basically this guy was going to buy a property. He bought this property from a seller. Now this seller had a loan on the property. Okay, he took out a loan on the property. Now the home was located in Los Angeles County, but for whatever reason, they recorded the lien for the loan in San Bernardino County. Well, I believe it was San Bernardino County. Either way, it wasn't in LA County. So when they sold the home, when they got it into escrow, the title company that was working on the file, excuse me, the title company that was working on the file did not find that particular loan, right? So, and then the seller, you know, he wasn't a great person. He figured, well, if they didn't find this loan, I'm not going to say anything. Because then that would mean that my property looks like it's free and clear when it's really not free and clear. So anyway, long story short, the transaction closes, the buyer buys the property, right? He has title insurance, the buyer. Well, within a couple of weeks of owning the property, he signs a deed deeding it to his own LLC, right? Remember, once you deed it to your own LLC, the title policy is no good. And then a couple of weeks after that, he gets a letter from the seller's lender saying, hey, I saw that the home transferred title over to you. We are the lender of the property. We never got our money when the property was sold. The house is collateral. You own the house. You owe us money, right? So of course, this buyer is confused. He's like, well, good thing I have title insurance. He filed a claim with this title insurance company, and then they denied his claim, all right? So he had to hire a lawyer to get this all sorted out. It's very unfortunate. Now, the only way that would have worked is title insurance company, we issue a specific endorsement, all right? Endorsement is just a fancy way of saying add-on. So we offer an endorsement for $100. And that endorsement for $100 basically say, if I transfer property to my own LLC, I can continue to have title insurance coverage. All right. If I transfer it to my own LLC, not the LLC of somebody else, but my own LLC, I will continue to have title coverage. So make sure you get that. It doesn't work if you're transferring it to somebody else. Like if you're transferring title to your brother or to your friend, there's no endorsement for that. All right. Now, a lot of times people ask me, well, do I have to get another insurance policy? I'll be honest with you. When in my market, which has a lot of Asian homeowners and a lot of Hispanic homeowners in the area I work with, they like to transfer title a lot, right? They like to change title quite often, and I would say 98% of the time, people don't repurchase a title insurance policy. It's just not worth it. It's too expensive. All right, so just kind of keep that in mind. As we move forward. Now, the loan policy is a little bit different. The loan policy insures the buyer. I'm sorry, the lender. The loan policy insures the lender. Now, this loan policy is usually paid for by the buyer. All right, usually paid for by the buyer, and it's only good for the term of that loan. All right, that means if you were to refinance, you would be actually getting a new loan. So every time you get a new loan, you pay off an existing loan. And that's why when you do a refinance, you're going to see a lender policy. All right. So you're going to see a title policy, and that's what it's for. So something to know about lender's policy. I'll tell you another story. A guy was, I'll tell you another big fraud story, actually, where First American actually paid a really big claim. I've told the story often. We had this guy that owns a home out in LA somewhere. I think the home was worth $8 million, right? The homeowners, they spend part of the time in this country, part of the time in other countries and so forth. But the home was essentially free and clear, owed with no loan, worth about $8 million. Now, these criminals, I guess you could say criminals, created fake identities to pretend to be the homeowners and opened up a bank account under the homeowner's name and deposited $1 million of their own money into it. All right. Over time, they started making withdrawals and deposits. So there's actually a history. And then after a little while, they went to a lender and wanted to take out a $4 million cash out loan. All right. Remember, these aren't the real homeowners. Well, long story short, they did the loan. We insured the title. All right. We insured this lender. And then that was that. A couple of months go by. The actual owners of the property actually go home. They get something in the mail. They get a copy of the deed of trust, right? The deed of trust is the lien that gets recorded on title for a loan. They get a copy of it in the mail, and they're like, we didn't take out a $4 million loan. So they started making some calls. Long story short, go back to the lender. And they come back to us, I guess, and then we call the lender and we're like, lender, did you lend to these people? And the lender's like, oh yeah, I remember this loan. Yeah, they were great people. We went out to dinner, we met their kids, and then we're like, all right, well, that's not real. We went to the notary that notarized the deed of trust. Even the notary said, like, I remember these people, they were super nice. We chatted for a while, we did some other stuff for them. Anyway, it turned out all to be fake, right? It turned out all to be fake. So $1 million of their own money, they were able to get back $4 million. First American paid a pretty big, heavy claim on that one. So again, if you don't think fraud is out there, it's very much out there. Any questions before I move on? Okay. So we talked a little bit about how long these policies last, owner's policy, loan policy. So we'll just go ahead and skip that. What is the cost? Owner's policy, I would say the more expensive the purchase price, the more expensive the owner's policy. For the loan policy, the more expensive the loan is, the more expensive the lender policy is. So it just kind of goes by the purchase price and loan amount. Now, on average, a $500,000 home, the owner's policy is about $1,600, give or take. All right, $1,600. So it's not cheap. It's not cheap. And First American is actually already very competitive, but that's about the going rate out there. And then $1 million, a lot of people think, well, if 500,000 is $1,600, is a million, 3,000 or 3,200. No, $1 million is actually only about like 2,500, I think, $2,500. All right. Okay. Let us move on. So let's talk a little bit about different ways of holding title. All right. So this is a very common question that agents, newer agents, and even senior agents, they ask me. So we'll cover these different ways of holding title: tenants in common, joint tenants, community property divided survivorship, as well as some single person ways as well. All right. So when you're, let's start with single person, sole ownership. I hope you guys can all see this. I'm going to zoom in a little bit more. So if you're holding title by yourself, this is the most straightforward and easy way. All right. So if John Smith is holding title as a single man, and if John Smith is a single man, then on title, he is John Smith, a single man. That's it. Super simple. If John Smith is an unmarried man, he would be John Smith, an unmarried man. Now, what is the difference between a married man and an unmarried man? Unmarried man is just somebody who's been married once and then divorced. So the joke that we always say in our industry is once you're married, you're never single again. All right. So, and if John Smith, as a single man, or if he's an unmarried man, is on title and he passes away, that property is going to go to probate. All right. Probate is just a court process where the court determines who has the right to take care of this estate or this property. Now, another way John can hold title if he's a married man and he wants to be on title by himself. So then he would be John, a married man, as his sole and separate property. All right. Now, if John is a married man and wants to hold title by himself, then his spouse would have to sign a quitclaim deed or a grant deed or interspousal deed. Basically, his spouse would have to sign a deed in front of a notary, allowing him to be on title by himself. So a lot of times people ask me, well, can John, a married man, be on title by himself without his spouse signing a quitclaim deed? And the answer is yes, he can. Only if he were to purchase all cash. All right. If there's a lender involved, if John is purchasing property with a loan, it's not going to happen. The lender is not going to allow that to happen. But if he's purchasing cash, then it's okay. However, if he were to refinance, if he were to take a loan later, or when he goes to sell later, at that point, his spouse would have to sign the quitclaim deed. So sooner or later, the spouse would have to sign. All right. A lot of questions people also ask me is, well, my spouse, my buyer is married, but can he just say that he's single, right? Can he just write he's single, right? I get a question like that every once in a while. My response to that is, I didn't hear you ask me this question, but you figure it out. Like, we're not gonna know, right? So don't lie, but if something comes up, right? If a marital issue comes up on title and you don't want the buyers to go back and say, my agent told me that it's okay, right? So just make sure you're protected. At the end of the day, that's really important. That's the most important. Okay. Any questions on how one person would hold title by themselves before we move on? What is this blue stuff? Okay, well, so let's move on. So when you have more than one person on title, they have to choose one of these methods, all right? One of these methods. Now, let's talk about, let's start with I'm just going to go over some of the main differences of each. So you kind of have an idea of how to kind of advise your client. Now, remember, I'm sure you guys have heard, you don't want to tell your client what to choose, right? Because a lot of these will have tax and legal ramifications. So, but you do want to kind of understand the main differences between them so you can advise your client and then allow them to make the decision, all right? So let's go over these choices. If your client tells you, hey, I'm buying property with my friend and I want to have 60%, he's going to have 40%, then in that case, the only option you have is tenants in common, all right, which is this one, tenants in common. Tenants in common is the only choice you have, allowing people to hold separate interest, all right? However, with tenants in common, there is no right of survivorship benefit. There is no automatic right of survivorship benefit. That means if party A were to pass away, then party A's 60% would have to go to probate court. All right. So that's the main thing with tenants in common. Now, this might work great for people, for friends or partners, business partners, right? Because maybe if we're buying $100,000 home, I put in 60,000, he puts in 40,000. We want to have that separate interest, right? We want to have that separate interest. And maybe if he were to pass away, he doesn't want the property to automatically go to me. Maybe he'd rather have it go to probate because maybe he has a will and he wants it to go to his family and whatnot. So this might make to be a better option for them. Moving on, joint tenants. Joint tenants almost work exactly the opposite as tenants in common, all right? Anybody could be joint tenants, husband and wife, friends, you know, spouses, whatever. But everybody has to hold equal ownership interest, all right? So if two people are on title, then they own the property as a whole, all right? There's no 70, 30, 65, 20, 35, whatever. You own the property as a whole. Now, with joint tenants, you do have an automatic right of survivorship benefit, right? If party A were to pass away, the property automatically goes to party B without having to go to probate. All that would be needed is a certified copy of the death certificate for the deceased. And then party B, which is the surviving joint tenant, will sign an affidavit in front of a notary. You record the affidavit with the death certificate and boom, done. All right, simple as that. Now, let me take a pause right there. All right. Lately, we've run into more cases. I've noticed a lot of foreign buyers, you know, who've purchased homes here a few years ago, don't live here anymore, and a lot of them are now dying. Well, not a lot, but I'm sorry, that sounds very morbid. But few of them have now passed away, and their surviving joint tenant is trying to sell the house, but then the death certificate is from China. What do? Right? So if they're joint tenant, the law still is the same, right? It doesn't matter if they're a foreigner. The law says if you're a joint tenant, then if party B passes away, and even if party B is a foreigner and passed away in, say, China, as long as they record a death certificate and an affidavit, party A owns now the house, party A can sell, no probate, all is good. The only thing is the county recorder will not record a foreign document unless it is translated and then certified, okay? So you have to take the original death certificate, have it translated by a certified translator, right? And then that certified translator has to sign this certificate, like this declaration form, right? And then all that has to be mailed to the county to be certified. Then once it's certified, then you have a recordable document. Right? So very interesting. I'm learning that, learned a lot of that recently, actually. All right, next is community property and community property right of survivorship. So for the sake of time, I'll just talk about community property right of survivorship. Not many people use this one anymore. Most people just use this. Now, community property right of survivorship is very much similar to joint tenants, except it's only reserved for spouses, all right? It could be only see a married couple or domestic partner, only reserved for spouses. Excuse me. And you also own it as a whole, all right? There's no separate different interest. There's also automatic right of survivorship benefit, all right? So very similar to joint tenant in that sense. However, I will tell you, although we can't tell people what to choose, I will say that a lot of married couples now are choosing community property right of survivorship over joint tenant. The reason is very simple. The reason is obviously you get that automatic right of survivorship benefit to avoid the probate. And also because it has a full step up tax base benefit, all right? It has a step up tax base benefit. So for those of you, I'm not a CPA, full disclaimer, all right? I'm not a CPA, but I'm gonna do my best to explain to you the concept of how a step up tax benefit works. It really relates to capital gains tax paid when the property is sold. So let me get my little whiteboard up. Give me one sec. Excuse me, it's really dry, so. How do I? Here we go. Okay. Hopefully you guys can all see my screen. So let's talk about the step up tax base a little bit, okay? Let me step up tax base. Now remember, this is a very simple, I'm explaining just the basic concept of it. You know, your CPA and so forth should be able to kind of give you a better idea. Now, this is how it works. Let's say that in the year 1980, you purchased a home for, I don't know, let's just say 100,000. Okay, this is your base. Now that same property right now is worth $1 million. Okay, this is the fair market value today, right? And if I were to sell this property today, I know there's, you know, 250 for single, 500 for married, there's depreciation, there's all of that. We're just gonna forget about all that for a second. We're just gonna do simple, okay, simple. If I were to sell this property today, I would make $900,000, right? And I would have to pay capital gains tax on this 900,000. Why? Because my base is 100. I sold at the fair market value of $1 million. I made 900,000. I pay taxes off 900,000. Here's how step up tax base works. Let's say I own property as community property of right of survivorship with my spouse, right? And the same scenario, let's say, you know, husband A and wife B, you know, the couple A and B, they purchased in 1980 for 100,000, and then now that home is worth $1 million. All right, still community property right of survivorship, husband and wife. Let's say, for example, they always say the men die earlier, right? So, knock on wood. So let's say the husband goes out, gets into an accident. Today, he passes away. Well, what ends up happening is this base value will then step up to the fair market value on the day he passed away. Let me repeat that. So the base value will step up to the fair market value on the day the husband passed away. So if the husband passed away today, the fair market value is $1 million. That means the $1 million is the new base, all right? So if the wife next year, she's feeling very sad, she wants to sell the property, she sells it for $1 million. Well, if she sells it for $1 million, the base is $1 million, she made zero gains. That means she pays zero taxes, all right? If she sells it for 1.1 the next year, well, then she's made $100,000. Hopefully that makes sense. It's a little hard to describe, explain sometimes over Zoom, but hopefully that makes sense for you guys. So if the ownership percentage changes. Yeah, so Tiffany's asking, hi Tiffany, if the ownership percentage changes after the close of escrow, the same owner, is the title insurance still valid? Yes, so the ownership didn't change, just the percentage interest So their title policy is still valid. A lot of times people ask, well, so that makes me think like, can I change my vesting after I purchase the property, right? And you can. Can I change the percentage interest after I purchase the property? Yes, you can. You would just record another deed essentially. So if let's say you purchased as joint tenants between you and your spouse, and now you want to change it to community property or right of survivorship, you would just have to have another deed deeding from you to you, right? You're just deeding from yourselves to yourselves, but you're doing it for the sake of changing the vesting, all right? And that would be sufficient. Okay, so those are the 4 methods. Let me go back to my share screen here. All right, so those are the 4 methods. Now, another common way is also right here, trust, all right? So let me talk a little bit about trust. So you can hold title under a trust. And here's how a trust works. Some of you on the call may already have a trust. Oh, actually, before we move on, let's talk about, let's answer some of these questions. How about husband deed to husband and wife? What about the, Jessica, what about the husband to husband and wife? What is the question? So I'll wait for let her respond. Weena, you had asked, how do we prove the fair market value of the property? Does the surviving spouse need to have an appraisal done and the property dated? And you know what? I don't know exactly how the CPA, how they do the calculation, but I will tell you this. Weena, a lot of times we get asked for comps from like 1995 for a property. And we'll provide that. We'll provide comps for a particular property from like 1995 or 1990 or 1980. And I assume that's something, you know, that's probably one of the things the CPA uses when they apply for it. Hopefully that answers your question. Jessica, so going back to your question, so how about the husband, if the husband were to deed to husband and wife, would they need to buy a new title insurance policy? In those situations, no, you don't need to buy a new title insurance policy, Jessica, because the original insured person is still on title. So there's still some coverage. So good question. Now, before I just want to add to that, keep in mind, guys, any changes in title could trigger the property taxes to be reassessed, all right? Any transfer. Now, adding somebody on is a transfer. Taking somebody off is a transfer. So any transfer could trigger a property tax reassessment. The only times it does not is when you transfer it to yourself. For example, if I transfer it to myself, but I'm changing the vesting, right? Or I change it to my trust. Or if it's a transfer between husband and wife. When it's a transfer between husband and wife, the property is not, does not need to be reassessed. Or if it's a transfer between parent and children, right? So if I transfer the property to my son, then the property taxes would not be reassessed. Or if it's a transfer from grandparent to grandchild, all right? There's a little detail here. Parent and children works either way. Children can deed to parent, parent can deed to children, it will not be reassessed. However, with grandparents, only grandparents can deed to grandchildren and then would not be reassessed. All right, let's go back to the questions here. So what if the new owner changes vesting from single person to LLC that has members in addition to him or herself? Is title insurance still valid? So in that case, you would then want to get the operating agreement for the LLC, supply it to the title company. The underwriter will then review it to see if they're eligible for that endorsement I was talking about. All right. Generally speaking, if you know, if you're part of it, then it might work, but you want to supply it to the title company that provided the title insurance for your home when you purchased it. But definitely, I think it's $100, definitely worth doing. $100 plus the recording fee. Austin, does the base of the property value only step up when either spouse passes away? Any other circumstances when the step up kicks in? Austin, I believe that you can also, if step up also applies if the beneficiary of a trust inherits the property through a trust. So if the property is in a trust And then, you know, and it's like John and Jane's trust, and John and Jane passes away, and their kids inherit the property, then I believe that would be a step up. A lot of people use it in a 1031 exchange situation. For example, they might set it up so they keep exchanging properties, exchanging, and deferring taxes, until one day they pass away there, and then their heir inherits the property. Then their heir will get a step up in tax base, and basically all those taxes will get wiped out. So, so those are some of the ways that I know of. But I'm sure there's, you know, estate planning attorneys and CPAs out there that would know more. Okay, hopefully that helps. Now, I hope that answers your question, Austin. Now, talking a little bit about about trust. So you can hold title under a trust, all right? But there's a couple of things that you need to know. First is all trusts more or less work the same way, all right? Some are more complicated, some are more simple, but the basis of it is kind of the same, all right? You have your trustor. The trustor is who creates the trust. So if my wife and I go to an attorney, we say, hey, attorney, we want to create a trust. Well, it's our trust, we're the trustors, all right? Very simple. Then you have your trustees. The trustee is who manages this trust, right? Who we are saying like, hey, we want you to be the manager of this trust to make sure all the instructions within the trust are followed, all right? So if you take a listing and the property is under a trust, then the trustee would be the person signing all your contracts, your grantees, and so forth, right? And then a lot of the times the trustors make themselves the trustees until they pass away. You know, then they have successor trustees, and if the successor trustee can't perform, then there's a successor trustee, and so forth. And then you have your beneficiary, right? Beneficiary is pretty self-explanatory. Who gets to benefit from this trust, all right? So those are usually the three main rules. Now, here are the couple of things to remember, important things to remember about trust. One is the title of the home has to be changed into the trust. I literally have a case right now. I feel so bad for this guy. His mom passed away. She had a trust created, but they did not change the title of the home to the trust. They still had the title of the home under her individual name. They even had the deed created, changing it to a trust. It just never got recorded, all right? And then unfortunately, the mom passed away. They thought it was in a trust because she made a trust, but it turned out they never actually recorded the deed, deeding the property into the trust, which then now the son has to go back to court and then hire an attorney to get this all sorted out. Okay, so that's very important. Secondly, trusts most of the time do not allow for a power of attorney to be used to sell a home. All right, trusts have power of attorneys for like if I'm, you know, if you need to act on my behalf, mental, you know, if I'm sick and you need to help me seek medical help or whatnot. But in terms of real estate transactions, I would say 80% of the times, trusts do not allow for power of attorney to be used. So if your trustees are telling you, hey, you know, hey, Alan, I have to go to Taiwan for 5 years or whatever. I have to go, you know, on a trip, and I need to, I want to give power of attorney to somebody. If that were the case, I would say, well, let me review a copy of the trust first, because chances are it's not going to say it allows for it. Sometimes it does, but most of the time it doesn't. Okay. Also, if your trustee it has not passed away, but they're incapacitated, meaning like they're, you know, maybe they have Alzheimer, maybe they have dementia, maybe they're just in a coma, right? Or something along the line of that, but they're still alive. How does the successor trustee take over? Well, again, we have to look at the trust. I will tell you this, 90% of the trust that get sent to us say that 2 doctors' note needs to be provided, whether to state the person is healthy or whether to state the person is unable to act. I would say most of the time they say 2 doctors' note. And why I'm bringing that up is because sometimes we get a lot of sellers, maybe they have dementia, they're in China, and then they have a doctor's note, right? Say, here, see, here's a doctor's note showing my father has dementia. I'm the successor trustee. I should step up to sell the house. And then we tell them, well, your trust states you need 2 doctor's notes. And then of course they argue with us because they said, well, I can't get to doctor's note, right? My dad is, at hospice care in our house. There's no way we can get to doctor's note. Why are you being so difficult? And at that point, all I can tell them is, I'm sorry, it's not us being difficult. Your father's trust specifically states 2 doctor's notes. We have to follow what's written in the trust, right? So if you guys out there, if you're creating your trust, just be very cautious of what's stated in the trust, how you want it. Do you want a power of attorney to be allowed to be used if you're to sell the house? Do you want 2 doctor's notes? If you're unable to act and the successor trustee to step up. Like, pay attention to these things because they do matter. All right, and then, so moving on from trust, the most other common way is holding title under an entity. So, you can hold title under a corporation, an LLC, and so forth. Of course, if that were the case, when you sell the house, we would want to see for example, the operating agreement if it's an LLC, or the articles of incorporation and bylaws if it's a corporation. Our main job here as a title company is make sure whoever signs on behalf of that entity has the authority and the right to do so. All right. Okay. That was a lot. Okay. Okay, let's go back to this. So let's talk about a little bit, actually, before I move on, any other questions? Let me check the chat screen. I don't want to miss anybody. Okay, all right. Does the property and trust have the 200 capital gain primary tax benefit? Jessica, that's a good question. I'm not sure, to be honest. Not really my specialty on that part. When it's under a trust, so probably a tax specialist would know a little bit better. No, we know revocable living trust doesn't need to go to probate. Usually if it's under a trust, revocable, unrevocable, the whole point of that trust is to avoid probate. So I think the revocable and unrevocable doesn't really apply for us, at least, in this particular case. I know for tax purposes, there are reasons why they do it in a certain way. But for us, for title's sake, not so much. All right, let's talk a little bit about some of these title red flags. Now, I'm going to show you some examples of a preliminary title report. So the preliminary title report is the title report that gets issued once you open escrow. It basically outlines everything that's recorded on title. Any issues on title that needs to be taken care of will be on this report. All right, any liens, any red flags, and so forth will be on this report. And usually we issue this report when property goes into escrow or when the listing agent takes on a listing. So if you have a listing, you're welcome to call us and say, hey, I just took on a listing. Can I order a prelim? And then we'll get it out for you. I personally review every single prelim. I review every single one for my clients on all your purchase files. I tell you guys before, usually it comes out, if it comes out today, I review it in 24 hours. I'll tell you guys some of the main key things to pay attention to, any red flags to look out for, and so forth. That's why I'd say it's so important if you take a listing to order it when you take the listing, because a lot of the times we find out there are issues that needs to be resolved. And sometimes you don't have enough time to do that in escrow. All right. So let's take a look at some of these prelims. I've highlighted a couple of things. Now, sometimes in the prelim, you'll see something like this. You'll see a line item number 8, all right, saying, or maybe 7, 6, the number doesn't matter. That's any defect, liens, encumbrances, or matter which name parties with the same or similar name as Anthony Luna. It just so happens this property's owner is Anthony Luna, okay? But it's just saying that what this is really saying is we need a statement of information from Anthony and Jennifer. And the reason why we need the statement of information is, first of all, the statement of information is just a one-page form, or two-page form asking for the name, social, date of birth, where you've worked, where you've lived, You guys probably have all seen it. And the reason why we ask for that is because not all liens are attached to the title of a property. A lot of liens, certain liens are attached to the actual person. For example, if you owe the IRS money, if you have like an IRS federal tax lien, the IRS doesn't know how many property you own. What they do know is that if you make money, we want to get paid. So they might lien you, right? They might lien your social and so forth. So the statement of information allows us to find those types of liens, or judgments, child support judgments, for example, and so forth, right? Also, it also allows us to make sure that all the liens showing actually belong to our seller. Because, for example, some people have very similar names, especially in the Hispanic community. We have people, father and son, sharing the same names. We run that into that very often. So we want to make sure that the liens that are showing up belongs to the actual person, not just somebody with a similar name. Now, it's very important to get that SI back to us early. A lot of the times we get into a situation where people return it to us, or escrow returns it to us like 4 days before closing, 5 days before closing. And then we take 1 day to run the SI, and boom, a judgment pops up, a lien pops up. And then people are upset, like, how did you miss this? Like, why is this happening last minute? That's the reason why. I would say 90% of the time when a lien pops up last minute in your file, it's because the statement of information wasn't returned early enough. If you'll see here, deed of trust. Again, deed of trust is just a loan for a mortgage loan. In this case, it's a mortgage loan for $350, dated December 29, 2014, with Wells Fargo. That's it. Escrow is going to see this, and they're going to know, oh, I need to call Wells Fargo to get a payoff demand to know how much to pay this loan off, or how much is it to pay off this loan to get it released. All right, let's look at some other stuff. All right, here we go. So this is a great one. So on this one, you see a deed of trust for $330 with Wells Fargo again, dated March 29, 2006. And then on the bottom here, you see something. It says the effect of a document titled Full Reconveyance, recorded 2016. The company will require satisfactory proof of full payment of the debt is paid. What does that mean? All right, now you guys know I said when you take out a loan, you need to get a deed of, the lender is going to record a deed of trust on your title. That's a lien, right? Now, if you were to pay off that loan, how do you clear that lien off title? Well, if you were to pay off a loan, the lender or the trustee for the lender would record another document called a reconveyance right here, right? Would record a document called a reconveyance. This reconveyance essentially clears the loan. Now, there's already a document recorded, a reconveyance recorded. Why is the title company still asking for proof of payment? And the reason is because of fraud prevention. All right, I'll tell you a story. A couple of decades ago, before the internet and PDF and everything like that, some guy figured out that, well, if all I need is a reconveyance recorded on my title to show that my loan is paid off, then why don't I just create a fake reconveyance, right? So that's exactly what he did. He stole a copy of a reconveyance. This was before the internet. He stole and he forged and created his own reconveyance, and he recorded it against his loan on the title for his house. And so now his home looks as if it's free and clear. So on title, his home looks like he owns nothing. So what he went to do is he went and got a loan, right? Think about it. He just went and said, hey, lender, I have a free and clear property, 100% equity. I want to cash out, right? So he did that. And then when he cashed out, of course, they recorded a deed of trust on his title. He forged another new reconveyance, recorded that, and now his home now looks free and clear again. So he just repeated the same thing. He went to a different lender saying, hey, I have a free and clear home. I want to do a cash out refi. Did it again. He did it like 5 or 6 times, I think, until he eventually got caught. So title companies are very, very wary about reconveyances that get recorded too early. For example, this one, right? They took out a loan in 2006, and in 10 years, they paid off the loan. Now, I'm not saying that's impossible. A lot of people pay off their loans early, 5 years, 10 years, and so forth. But when that happens, we don't see it that often. So when we see a reconveyance record early, title company usually asks, do you have proof that another type of proof that the property got paid off, right? Do you have a letter from the bank? Do you have receipts, payoffs, and so forth? So we wouldn't ask this for a refinance because refinance makes sense. You take a new loan to pay off an old loan. It's only when you like just pay off your loan all of a sudden. Now, I need to stress this next point, all right? You guys pay attention. So you also want to make sure if you do pay off a loan legally, if you actually pay off a loan, that the lender actually records a reconveyance, all right? It's, believe me, it happens so often where the lender forgets to record a reconveyance. The homeowner doesn't know that there's supposed to be one. Then 10 years later to try to sell the home and that lender's gone out of business. I'm dealing with one right now, all right? This poor guy, he did a loan mod. It's supposed to have wiped out his second, all right? The lender never recorded the reconveyance. They went out of business. And now this particular loan still sits open on title, making it extremely difficult for him to refi, right? So make sure that they do provide a reconveyance and it gets recorded, all right? Same thing with private lenders. A lot of times you take out a loan with the private lenders. Now they know how to put a lien on your home, but they don't know how to release it. So you want to make sure that a reconveyance is obtained. Austin, your question, do we need to submit a statement of information to both title and escrow separately, or is one enough? One is enough. You could supply it to escrow, but really it comes back to us. So either way, you can give it to escrow, you can give it to title. I would only say if it's an escrow, that if it's a good escrow, they'll know to get it back to us early. Some escrows, I will be honest, either they're too busy or they're not sure. They get it back to us late, and then we run into a situation where a lien pops up last minute. That's unfortunate. So the rest of the prelim is I have some pretty simple examples. I mean, you'll see, a notice of homeowner association, right? HOA lien. It's pretty standard. Escrow will call this Arbor Homeowner Association to get a payoff. Judgment for child support. I'm dealing with one right now. Poor guy. He owns like $200,000 in a child support judgment, right? And then they negotiated with the court saying that, well, if you're selling your house, we're not going to wipe out the judgment, but we'll let you sell the house if all the proceeds come to us. So that's exactly what's going on. They're releasing the judgment, what's called a partial release, right? Partial release, meaning it's still going to show because he's not paying off the full amount. But as long as the proceeds, all the proceeds, which I think is like 80,000 or 100,000, goes to pay the court, then they'll partially release this judgment, allowing him to sell the home. What I'm also looking for, I don't think it's on here, but on title, sometimes you'll see here the owner name and it'll say subject to something. So it might say Diane Solomon and Rena Solomon, subject to item 5. And then item 5 will say something like, there is a uninsured deed affidavit that's required for a transfer from A to B. I know it's a little hard to understand, but just try to keep up, try to follow me here. So what I'm going to talk about now is called uninsured transfers, all right? Now, after you purchase a property, you can change title however way you want. If you buy a property and then you want to change it to your dad's, that's fine. If you want to change it to your brother, that's okay. But any transfer done after the close of escrow, unless a new policy is purchased, they're all called uninsured transfers. Still legal, but it's just uninsured because there's no title insurance, right? So let's say you buy a property, right? Let's say Laura buys a property, and then a year later, she decides to change the title to me, to Jerry, right? She just says, hey, I'm going back to Hawaii. You've been such a good friend. Here's my property. Hint, hint, Laura. So now the title's under my name, right? She signs a grant deed, records it. Now it's under Jerry. Now, 2 years, 3 years goes by. I'm like, hey, I want to sell the house. Well, when I put the house, when I get the house into escrow and they order a prelim, that prelim is going to see the uninsured transfer between Laura and myself. And they're going to want Laura to sign a document called an uninsured deed affidavit. The reason we ask for this is very simple. It's also for fraud prevention, right? Because what if Laura didn't really sign that deed over to me, right? What if it was a fraud? What if I found a fake notary and then forged her signature and then recorded deed? She didn't even know, right? What if she was under the influence when she signed that document? She didn't know what she was signing, right? What if there was an elderly situation where there's like a 90-year-old elderly parent and then she was coerced by one of her kids to sign the property over to just themselves when she has like maybe 5 kids or 6 kids. So these are all things that we've learned from history that becomes an issue, becomes a claim. And this happens a lot in our industry, at least in our market. You know, where they do these uninsured transfers back and forth. And then when we say we need to go back to the original person asking them for this uninsured deed affidavit to sign, they can't sign it, right? They can't sign it either because they don't know where they are. They don't want to sign it. They want money to sign it. So it's a very, very important thing. This is one of the main things that kind of slow down escrow, one of the main red flags that we see. So be very cautious of that, okay? My time is almost up. I got 3 minutes left, guys. I could keep talking, but I want to save the last couple of minutes for questions that you guys might have. You're welcome to unmute yourself or just type in the chat box. I'll give a minute. Any questions? Well, guys, I will, you know what? Let me go to the chat group or the chat box and I will leave my information. Okay. So if you have title questions, questions on property taxes, anything that I talked about today, you're welcome to message me, call me, text me. Very good at getting back to people. I'm happy to help. My goal is here to help you guys. We also help agents with farming, right? We also help agents with your, if you have listings and you need like shoe covers, face masks, hand sanitizer, wipes, and so forth. We have all that for you guys. Really what we're here for is to provide value to you. So in hopes that when you open your escrow, that you choose us or you choose myself as the sales rep for your title business. So we're here to earn your business by providing information like here today, and also you know, supplies and products and other services to help you guys be more successful in your business. So thank you everybody. Thank you, Laura. I think if there's no other questions, then I'll end it here. If you guys do have questions, feel free to shoot me a message afterwards, okay? All right.